You are very welcome to this Center for Global Finance Research Seminar today. Today we have an interesting seminar by a speaker who is not new to Center for Global Finance. Indeed, she has been extremely active in the seminars, conferences, and research projects of the network. But still, I think let me introduce her formally so that we can understand her background. Esmie Kanyumbu is very well known to us, as I said, but she's also a senior analyst at the Reserve Bank of Malawi, which is the central bank for Malawi, where she's responsible for facilitating and recommending ways of deepening financial markets in the country. She's been very active in many research cycles, in particular the African Economic Research Consortium, where she's a permanent member of Group C, which is finance, but also has held distinguished positions as visiting scholar at the International Monetary Fund in Washington, the last being about a couple of years ago before lockdown in 2018. But Esmie is also very networked within the research circles. She's also a research fellow at the Southern African Institute for Economic Research, the SAIEAR, in South Africa. And her current research interests are focusing on interbank markets, financial inclusion, financial markets development, monetary policy, and financial stability and international trade and finance. She's also been active in the ESRC FCDO research project on delivering inclusive financial development and growth, a network of research, including many institutions, including Loughborough University, and including a number of central banks, including Reserve Bank of Malawi. At the moment, Esmie is putting final touches on her PhD thesis at Loughborough University in the UK, and I'm very pleased to say that in the audience we have also some colleagues from Loughborough University, Professor Grace Green, Dr. Kavida, who are working closely with Esmie. In terms of background, she holds a Master of Arts in Economics and a Bachelor of Social Science degree, both from the University of Malawi. What is particularly important about Esmie and the work she's doing on interbank markets is that she's been at it for quite a number of years, and she's aligning it to the current developments in the Eastern African, Southern African region, where the African Development Bank is facilitating the coordination of a cross-border payment system, including the transaction that relate to the interbank market. So this work has high potential for research impact in terms of the research excellence framework of the UK, whereby the idea is to follow the research that is strong on theory, strong on empirical work, and how it translates into research take-up in terms of policymakers and practitioners. And given the ongoing work in the area, including Reserve Bank of Malawi, I can see the highest potential of research take-up of this work. I will not go into the detail. Leave it up to Esmie to share with us exciting work. But Esmie, you are most welcome. And please go ahead and share your work with us. Esmie, you have the floor.
Thank you so much, Chair, for introducing me quite well. And thank you for giving me this opportunity to present at this forum. I hope you are able to see my slides well.
Yes, indeed, yes.
Okay, thank you so much. Today, I've been talking about interbank markets for a number of times, but today I want to talk about the role of this market when it comes to bank risk, and I'm using Malawi as a case study. And this work has benefited, or I should say is benefiting a lot because it's work in progress. It's benefiting a lot from the input and comments and advice from my supervisors, Professor Christopher Green and Dr. Kavita Srichandi, who are also supporting me. They are here in the house to take care of their baby, to see how it goes with their baby. So I thank them so much. And in a special way, I should also thank Professor Murinde for activating the passion in me about interbank markets. We met in 2014 in Zambia, Lusaka, and we talked about interbank markets. And from there, the interest was activated. So let me thank Professor Murinde again. And today I'll be talking about the role of interbank markets discipline on bank risk, as I've already said. So I'll give a brief description of what interbank markets are and motivation of this study, the objectives and the literature and the data and methodology, and a discussion of the results and conclusions and some implications. So as a way of just giving an introduction, what are interbank markets? These are markets where banks lend and borrow funds from each other to meet their daily liquidity needs. And these markets are very important in that they provide one of the most important funding channels for banks. And in addition to that, they facilitate the smooth functioning of the financial system. You may recall that it is the dry up of interbank markets in 2017, 2018 that brought up the financial crisis of that time. So some liquidity gaps are closed before central banks takes action. Banks are able to help each other to cover each other in terms of their liquidity needs, even before the central bank can come in. And interbank markets have been classified as unique markets. Why? You know, in a normal market, in a normal loan market, you talk of collateral. But in interbank markets, loans are both collateralized and uncollateralized. And because of this aspect, trading depends on trust. It depends heavily on trust. So following that, there's a lot of PM monitoring and strong discipline mechanism in such markets. And there's also the strong relationships. So banks build relationships, borrowing and lending relationships between themselves. As I've already said, interbank markets are associated with PM monitoring and market discipline. And this discipline mechanism is reflected in the ability of individual banks to borrow from these markets, and also the rate at which they borrow from this market. Specifically, research has shown that riskier banks find it difficult to access funds in this market. And that's where these banks, the riskier banks, are able to get the funds. They get those funds at higher rates compared to safe banks. And much as we know this, we have quite a number of work which is done on this subject, including the work by our chair, Professor Murinde, Professor Green, and other authors in the house, including Dr. Bwire and myself, and also some area researchers like King, Forfen, and Coco, about what determines the rate at which banks borrow from each other, and also what determines access, the ability to access these funds. The role of this disciplining mechanism has not been well accounted for. So how credit rationing and pricing of interbank loans affect banks' risk-taking behavior. This hasn't been accounted for. And this study aims to fill this gap by assessing the effectiveness of this market discipline on banks' risk-taking behavior. So the study specifically aims to assess the impact of interbank monitoring and discipline mechanism on bank risk. This is the interbank's role of moderation of risk within the banking system. This is what we are trying to do, to assess the role of moderation risk, the role of interbank market when it comes to moderation of risk within the banking system. So the underlying hypothesis of the study is that bank risk is lower for banks with high participation in the interbank market. And we are trying to answer two questions here. First of all, how do credit rationing and pricing of interbank loans affect banks' risk-taking behavior? And can interbank markets complement regulators' efforts aiming at promoting the safety and soundness of the financial system? So, as I've already said, I'm using Malawi as a case study. Using Malawi as a case study offers a good case study because most of the salient features are similar to many markets in the low-income countries. For instance, this market is dominated by commercial banks. It is a small but active market. It's small in terms of the number of participants and also the volumes of trades. And there are also both secured and unsecured interbank loans in this market. Other than that, this market is also dominated by overnight trades and confined to banks operating within the country. So there is no cross-border interbank interbank trading. And one of the outstanding aspects is also that it's common for banks to rely on central bank for liquidity, besides interbank market having ample liquidity. This also shows the structural rigidities in low-income countries when it comes to interbank trading. So what is it that is in literature? In line with the role of interbank market on bank risk, there are two opposing hypotheses, one of which is the market discipline hypothesis, and which stipulates that banks are well suited to assess risks of peers and mitigate the risks by providing superior monitoring services. And according to this hypothesis, interbank market discipline contributes to the financial stability because monitoring activities among banks incentivize banks to minimize losses. This implies that market discipline is important for the soundness of banking system and for financial development. And the opposing hypothesis is the contagion hypothesis. And according to the hypothesis, interbank exposures are a potential source of contagion. And this implies that interbank market exposures have the potential to amplify liquidity shocks and hence contribute to the general banking system risk. So what do we have in empirical literature? We have a number of, not quite a number of literature in line with the role of interbank markets on bank risk. At the same time, we have mixed results when it comes to the relationship between interbank market risk, discipline and risk. And one of the outstanding differences of the studies which are in existence is to do with the way how bank risk is measured. So for example, the study by Murinde et al., that's our chair, on Kenya, they found that there is an inverse relationship between interbank activity and bank risk. However, this inverse relationship only holds to a certain level, beyond which the impact on risk was reversed. And for them, they used log of ratio of net charge-offs to equity as a measure of bank risk. For Tova Garcia on Mexico, they use Z-score as a measure of bank risk and also reserve for loan loss. And they found no evidence that borrowers have lower levels of bank risk. And Dinger and Von Hagen, they used loan loss reserve to gross loans and loan loss provision and ratio of net charge-offs to equity, and concluded that borrowers have lower risk levels. And within the same region, Distinguin et al. 2013, they used Z-score to measure bank risk. And they concluded that higher proportion of interbank deposits results into lower levels of risk. And they found that interbank deposits do not moderate behavior of state-owned banks. So while interbank behavior can moderate behavior, risk-taking behavior of banks, that doesn't hold for state-owned banks, according to them. And Riodopo, 2010, Riodopo et al. 2010, they also used Z-score as a measure of bank risk, and they concluded that larger dependence on the interbank market increases bank risk. So in our case, because of that aspect of how to measure bank risk, we are trying to measure risk from two perspectives: to measure credit risk and also solvency risk, to see how participation in the interbank market is related to risk, but which type of risk. So we used data for we used bank level quarterly data for Malawi. The data runs from first quarter of 2010 to fourth quarter of 2018. That includes 14 financial institutions, 13 are banks, and one is a discount house, which had been participating on interbank markets. And we see differences in bank credit risk among banks, and we see that banks, these levels of credit risk have been changing over time. And the same with solvency risk. Yeah, there was diversity among banks. So some banks could improve in other quarters and they would go back the same. So it shows that there are differences in risk levels among banks. But the question now is, can these differences be explained by their participation in the interbank market? So instead, in terms of estimation, we regressed risk, a measure of risk, on a number of explanatory variables, including interbank market participation. So we measured risk from two different angles. First of all, credit risk, which we are measuring by loan provision, and specifically, we are looking at excess loan loss provision over and above the regulatory minimum level. So we are taking care of the regulation part into it. We are taking it out and looking at any excess loan provision above the regulatory level. And also measuring solvency risk using the Z-score. In terms of the participation on the interbank market, we are using the ratio of interbank borrowings to total liabilities of bank as a measure of a bank's participation in the interbank market, mainly as a borrower. And then we included capital adequacy ratio, which is being measured by excess capital over and above the regulatory minimum level. And bank size measured at the logarithm of total assets, and also ownership in terms of whether a bank is foreign or local, or whether it's owned by government or it's a private bank. And apart from, in addition to what other authors have done In this study, we have added macroeconomic variables into the model. We have added GDP and inflation, and also monetary policy rate to see the impact of monetary policy on bank risk. So in terms of estimation, we are using the Hausman-Taylor panel regression model, and we take it into consideration that interbank borrowing may be endogenous with respect to bank risk. As I've already said, that banks which are perceived to be risky banks are denied liquidity. So we take that into consideration. So the issue of endogeneity is taken care of. And this model is a combination of random effects, fixed effects, and instrumental variables. And it helps to distinguish between time variant and time invariant regressors. So regressors are subdivided into those that vary within cross sections and those that do not vary within cross sections, and would be dropped from fixed effect model. So we are trying to retain those the impact of those regressors that do not change within that do not change within cross sections. So we don't lose the impact of variables like GDP, inflation, and monetary policy rate. And this one advantage of this model is that it doesn't need external instruments from them to be used in the model. They are derived within the model, and it has also proved to be a consistent estimator. So what our results look like? For credit risk model, we find that there's a negative and significant relationship between banks' credit risk and banks' participation in the interbank market, which means that as banks are participating more and more in the interbank markets as borrowers, it helps them to reduce their risk taking. And for this, on the part of solvency risk, we find the opposite. We find that there's a negative relationship between solvency risk and interbank participation. Well, the negative thing means that the Z score is coming down. So when the Z score is reducing, that's the high probability of bank failure, the high probability of default. So in case of solvency risk, we find that participation in the interbank market increases the probability of default. So in summary, we find that banks with high exposure to interbank markets present low levels of credit risk. This is supporting the market discipline hypothesis. And on the other hand, a bank's exposure to interbank market increases its level of solvency risk. This supports the contagion hypothesis. This is also implies that persistent borrowing from interbank market potentially compromises banks' solvency. And this could be attributed to the relationship between funding sources and profit making. It has been found that interbank market provides a more expensive source of funding for banks compared to other sources of funding. And we also find that high capital levels reduce both credit risk and solvency risk. And this supports the importance of capital regulation by central banks. And we find that bank size has no impact on banks' credit risk, but bigger banks have higher levels of solvency risk than smaller banks. And we are attributing this to the too big to fail hypothesis, which stipulates that large banks are encouraged to undertake more risk investments, well, they are naturally possess the benefit of comprehensive security net. And compared to local banks, we find that foreign banks have higher levels of both credit and solvency risk. And we find that being a government-owned bank does not affect the credit risk, but it increases solvency risk of banks. I think this could be maybe due to inefficiencies of operating such banks, but also from the literature, state-owned banks have appetite to take more risks since they may be perceived as insured by government. Furthermore, we find that higher inflation reduces the level of credit risk. This could be explained as rising inflation could induce economic uncertainty that could stimulate banks to restrict lending in order to mitigate adverse selection. And monetary tightening increases banks' credit risk, but has potential to reduce the solvency risk. So this implies that increase in interest rates could make loan repayments more difficult, and that will result in increase in non-performing loans, and hence the upward adjustment of the loan loss provision. And lending rates increases on the part of solvency risk. That could be explained by the fact that lending rates increase more than deposit rates following a monetary policy tightening. So when the central bank increases the monetary policy rate, practically in most low-income countries, including Malawi, you find that banks have increased the lending rates, but that they also increased the deposit rates, but not with the same magnitude as increase in lending rates. So such higher interest rate spreads could result into more profits for banks, and hence the increase in Z-score. So what do we conclude from there? We conclude that interbank market can complement regulators' efforts of reducing credit risk. And while the interbank market may be a convenient source of funding for banks, it could be less suitable as a primary source of funds in the long run. So these conclusions are important, but as you can see, they are also mixed. So what are the messages? What are the implications? For bank managers, this will imply that there is need to gauge the extent to which it is prudent to continue borrowing from the interbank market. Of course, given alternative funding sources and also the liquidity needs. So where interbank activity expands balance sheets with relatively unprofitable business, reduction in the volume of interbank activity could be sensible. And for supervisors and policymakers, this means that they should aim to retain the benefits of interbank discipline and reduce the risks associated with such discipline. So as I've said, this is work in progress, and this is what I've done so far, and I welcome comments and inputs, questions, and thank you so much for your attention.
Thank you very much, Esmie. I think I have an echo. You can see that we are showing a hand of applause for this great paper, interesting paper, very adequately motivated, reviews the literature very clearly, identifies a gap that you're trying to fill in terms of the market discipline role played by the interbank markets in risk regulation, and also trying to connect other instruments like monetary policy. And then you obtain very important data and also at a reasonably good frequency for Malawi, undertake a plausible econometrics exercise, you generate very, very interesting results. And we resolve one of the long-standing issue that maybe the interbank market can be a source of contagion if there is a market discipline breaks down, or market discipline could be upheld, in which case we see reduction of risk. And it appears in Malawi it's the latter, that the interbank market is good in retaining market discipline. Very interesting results. Now, we do have a discussant for this paper, and Dr. Thomas Bwire has kindly agreed to serve as a discussant for this paper. Dr. Thomas Bwire is a senior official at the Bank of Uganda, but also at the same time is now a policy expert at the COMESA Monetary Institute based in Nairobi, which is the institute that coordinates the activities of central banks in the Eastern and Southern African region among the COMESA countries. Thomas Bwire has also been very active in researching the interbank market. As some of you may recall, he had some very exciting papers on the interbank market in Uganda at the 2019 conference, and spent some time at SOAS in that regard, and also for 2020 and 2021, he's been producing prolifically papers on the interbank market. So it's a great pleasure to have another central banker who is a researcher as well as a policymaker commenting on Esmie's paper. So Thomas, it's a great pleasure to invite you to give your comments on Esmie's paper.
I hope I can be heard. Thank you,
yes,
Victor.
We can hear you. Yes.
For such a wonderful introduction, and thank you, Esmie, for such a wonderful paper. Possibly for the benefit of Professor Green, before you came in, I was chatting Victor, and I was saying that Esmie has been working on interbank markets, and she mentioned since 2014. So clearly she's one of the few experts we have, and I think she deserves a professorship. And Victor was kind to say he could quickly award one. So we looked at that at the end of this session. Anyhow, having said that, Esmie, thank you so much. The paper is, like Victor said, it's well motivated, and the discussion is within the lines that we happen to know about the operations of the interbank market, and particularly for markets that are emerging and developing in nature. Having said that, I think I will not go bit by bit, because everything is quite pleasing to me. But I think what is much more important is what is it that we can say to improve on what has been done. And of course, a very beautiful input that you are bringing on board is that whereas majority of the papers that we have in the field have not benefited from the actual bank level data, which is usually hosted by central banks, you attempt to leverage from being a central banker to apply the actual data. And I think this is a very, very big input to this kind of work, because the numbers really speak to what we actually see. Now, having said that, if I can just go back to the motivation, which I liked very much. The interbank markets are associated with peer monitoring and market discipline, which is pretty in order, which has been found to be so. However, as the data continue to reveal, I think it might necessitate that we get back to this and try to revisit it and possibly recast it, because what is happening, or what we tend to see, is that whereas from a general point of view, riskier banks tend to find it difficult to access funds, and they tend to pay more to borrow from banks. Some of this the conduct of these borrowing banks, or some of them are being penalized for factors which is far beyond the actual measure of risk. They are penalized for factors which are not risk-based by any nature. And results, I could see brought in aspects like the size of the bank, aspects like the reputation of the bank itself, aspects like the reputation of the parent bank and its etc. These have nothing to do with a logical measure of risk, but by virtue of what they are, they tend to be penalized. In fact, we find overall that a category of banks dubbed as too big to fail often access credit at a much more rate, meaning that they are associated with a much lower risk. But when you come to the small banks, even if their risk measures are very perfect, they will still have to be penalized naturally for being small. In fact, I tend to think why the world hates small things, but this is what we happen to see, that because it's a small bank, irrespective of your measure of risk, you are still penalized and you pay a high rate. You are perceived as being riskier. Now, the question is, how do we bring this kind of findings, which you have actually in your results, to bear on such a general statement? So that the argument is that whereas this peer monitoring and market discipline is enhanced, sometimes some of the measures used are independent of the actual risk of a borrowing bank. Because that's what the data is generally giving us. Okay. The other thing that I would possibly speak to is this research question. Can interbank markets complement regulators' efforts aiming at promoting the safety and soundness of the financial system? Your guess, I mean, my guess is as good as what your results give. Yes, the answer is yes, but to what extent? To what extent can we take this? And why am I saying this? Quite often, we find that some of the banks that have got international affiliations tend to operate opaque credit limits. Now, by operating opaque credit limits, of course, which goes back to market segmentation, the efficiency within this interbank market is distorted completely. And as we speak, and as per your results, if we have this particular bank in Malawi, which has international affiliation, and the parent bank is applying opaque limits on it, then two things happen. One, the central bank is unable to gauge the true amount of liquidity that this bank possesses. And the other thing is that, okay, I think that's enough for this kind of work. That the regulation of the level of liquidity in the financial system is complicated because this affiliated bank is operating an opaque credit limit. And if a central bank cannot clearly tell how much liquidity is within the financial system, then its efforts at promoting the safety and the soundness of the financial system is compromised. So the issue is, whereas we cannot get rid of this, and it's something which is going possibly to carry on for quite a number of years to come. How do we get out of this kind of scenario? I would have loved possibly at the end, or maybe at the end of this discussion, that we try to come up with possible ways. How best can central banks go about this? And to me, one way could have been that these banks or the central banks should try to develop the collateral market as a way, because as you mentioned, much of the transactions are uncollateralized, and these international banks impose these limits because their worry is that their money is not collateralized. But if this money is collateralized, possibly they will reveal the true amount of credit, and these banks will operate normally like any other bank. So the question is, how do we develop, or how do we move from an interbank market, which is largely uncollateralized, to an interbank market, which is largely collateralized, so that the issue of these credit limits can, over time, be able to reduce? And maybe the other thing is, what if we recommended that there is need to enhance transparency and the frequency of information disclosure, and possibly with penalties for banks that hold the information, that don't want to disclose what they actually have? Would that discourage, would that impact negatively on the banking sector? I think, well, notwithstanding the negative impact that would have, but if a central bank would enhance this transparency and also enhance that information is appropriately disclosed, then some of these limitations that result in some banks being taken as risky and the others as less risky would possibly reduce, so that this interbank market can play the true role of the peer monitoring. The other thing I want to speak to runs from I think slide 10, where a very good model is specified. And the first thing I want to mention is you have two alternative measures of the dependent variable. One measure is the loan loss provision, and the other measure is solvency risk, which is the Z-score. Now, ideally, the understanding should be that these are alternative measures of the same thing, or you are trying to capture the same idea, but using alternative ways. And if this is very true, then first of all, one would expect results which are quite consistent across the board, so that whichever measure is, as has been used in the literature, we are able to say the conclusion is the same. This does not seem to be the case. If you go to the table for results in table 12, the slide for results in table 12, you will clearly see that in the majority of cases, whereas LLP maybe is giving a negative result, the Z-score is giving a positive result. In a few cases, are they consistent? But in majority of cases, they differ. So it would be interesting to really dig into that. Could it be that one measure has a problem? And I could clearly guess so. And I will speak to the Z-score, for example. If you look at the Z-score, there's a combination of two things. You have bank buffers, that's capital and profit, and then the risk that the banker faces. Okay, that constitutes the Z-score. Now, when you look at the capital to I don't know, capital to risk ratio, something like that, CARS, they tend to be higher for smaller banks. Reason being that this regulatory requirement that every banker must meet a minimum capital requirement. So if you're a bigger bank, your CAR is smaller. If you're a small bank, your CAR is higher. Now, from that kind of understanding, we begin asking ourselves, if we are measuring the dependent variable by this z-score, then would this specification which you have on slide 10, where you have car as well as size entering in the measure or entering to determine the z-score, would it be a very likely thing we must do? And then a related question would be, is there no chance that the kind of results we are likely to get could be counterintuitive? Maybe let us look at the results for car in the z-score regression. It's a positive number and very significant. How do we interpret that? That the higher the car, the lower the risk. I mean, the higher the car, the higher the risk. I think something of this one. But at the same time, we are saying, if a bank is small, its car is high. And because it is high, therefore the risk is also high. So does that result therefore speak to what would intuitively make sense of what we should be getting out of that? But it's food for thought. It's food for thought that I'm just trying to figure out with. And then a related thing to those results is, of course, first note that these are two competing alternative measures of the same thing. And ideally, we would have expected that results are consistent across the two models. That's the first thing. Number two, think about the interpretation of the results for the z-score with respect to the capital asset ratio and the size of a bank, whether we can intuitively draw meaningful conclusions out of what we see, given that the smaller the size, the higher the capital asset ratio, and the bigger the size of a bank, the lower the capital asset ratio, because they are all subject to the same minimum regulatory capital requirement. The other thing we need to pay attention to is, what do those asterisks stand for? And relatedly, what are these numbers in brackets? And I will give an example. Look at a variable like a foreign. It has 3 stars, and in the brackets is 0.7392. Suppose this number in brackets is p-value, except if it's standard errors, but if it is p-value, and of course this carries on, I can see it on foreign, I can see it on monetary policy rate variable, and then in some cases we look at a variable like inflation under the z-score model. Ideally the coefficients seem to be significant, but it doesn't have the asterisks. But these are simple things for checking and possibly making clarifications. What is it that you are putting where, so that you aid us to understand what exactly you are talking about. Now, there's a statement also which I read, I think on slide 13, if you can just get there. I think it's the last statement where we are saying interbank market provides a more expensive source of funding for the banks. Could you like to qualify this? Because if it is dependent on the tenure of the instrument on the interbank market, it carries water. Because what we have seen is that a tenure longer dated tenures, beginning from 7-day going forward, the rates tend to be higher. for example, the central bank rate. But for the overnight, it tends to be much lower. So I don't know. And number two, possibly, should we say this is being generated from the results we have seen because it's among the results? Would we sensibly say it's arising from the results? Although you see the source that's being given is not part of the numbers you have analyzed, but it is something for checking so that we're able to be very clear, especially if you could qualify in terms of the tenure of the instrument on the interbank market. Can I say I'm done? I thought I had a lot of stuff for Esmie. I think with those few remarks, Esmie, this is quite good work which is involving, and the fact that you are using the actual data, it gives us more reason to celebrate in the kind of output that we see. But definitely there's a lot you are going to get out of what you are discussing for the sake of improving the work that we shall be having tomorrow. And also congratulate you for being very clever, because we will not be able to look at the actual text. I don't know why you didn't want us to look at that chapter in the thesis, but it's okay. We understand. Chris could have said, please don't, but that's fine. That's fine. Okay, thank you so much, Victor, and thank you, Esmie. I hand over to you.
Thank you indeed, Thomas, for those absolutely helpful comments and suggestions made on Esmie's presentation. I'm delighted to see that you took time to go into the nitty-gritty details and which provide all food for thought in terms of wrapping up this paper and the other research related to this paper that which Esmie is doing. That's absolutely helpful. Maybe before I call upon Esmie to respond, maybe I should take a couple of other comments, if you don't mind, Esmie, and then you will come in to respond to some of these comments where you need so, or to seek clarification where the comment may not have been very clear. Okay, so at this juncture, let me open the discussion to the floor. We do have a button where you can click on the hand. For example, I have just clicked on my hand, and it has shown that I will make some comments. So I can see a number of hands going up, which is great. Teams is now a bit advanced. There is a lot of learning by doing. It can even number the sequence in which the hands went up. So I shall be faithful the sequence generated by Teams, and so I can see Adenor Senuga first, Sheila second, and Peter third, and Shelite fourth. So it's up to you, Oladapo. Although the name is Adenor Senuga, this is Oladapo, who is another very prolific researcher undertaking his PhD at the University of Buckingham. So go ahead, Oladapo.
Good afternoon. Thank you very much for the introduction. Esmie, well done on the presentation. It was quite insightful. However, I think one major concern I have is what Thomas has also raised, which has to do with the size of the bank and your measure of risk. And I think one way that you can adopt in improving the model is to look at risk taking at the portfolio level. because, just to extend what Thomas was trying to say, is that, the risk-taking at the portfolio level differs significantly by the size of a bank. The perception of how these portfolios are adjusted in terms of when it comes to the risk environment in the sector also differs across this bank. So I think you should look for a way to improve on the model to go further down to portfolio level. And also, what we have also seen is the rising size of the non-bank financial institutions across Africa, and how that is kind of impacting, how banks perceive risk and take risk in their operation. So again, you need to also look at the non-bank financial institutions in your model and see how that would probably lead to change in your results. Thank you very much.
Thanks, Oladapo. Very helpful comment. Well noted. Yeah. Ashula from the Bank of Zambia and SOAS University of London. Ashula, please go ahead.
Thank you very much, Chair. And
could you speak up, please? It's a bit.
Yes, so thank you very much, Chair, and well done to Esmie. Let me join the others in congratulating you. I think that the previous speaker basically took what I wanted to say, just in addition to what Dr. Boer said. I was thinking here that perhaps there's a lot of mention in the big bank, small bank kind of setup. So I was thinking that would that study look different if we went a step further to do the analysis and perhaps disaggregate the data into small banks and big banks and see what the results would look like. Because I think the risk-taking behavior, as the previous speaker said, is related to their asset size. So that was one of the issues that I was thinking about, perhaps in trying to improve the study. I know it's a lot of work, but perhaps it's something that may uncover some information that we don't know yet. Thank you so much.
Thank you very much, Shula. A very good discussion, very good comment. Let me now proceed to Peter Wamarwa from Central Bank of Kenya.
And first of all, thanks. I hope I'm audible.
Yes.
For this presentation and for Esmie. I must commend Esmie and join others to congratulate you for the amount of effort you have put in to deepen the research on this area. So the empirical results are quite amazing from what we have done before, and the recent papers and also empirical evidence is quite clear that you unearth the existing features of the interbank market in our markets. But there's one thing that Shula has alluded to, because there's tendency for the interbank market to have core and periphery, such that some banks come to the interbank market to just trade, but the frequency has nothing to do with the risk. So you can tease out these two effects of the risky banks that come into the market to trade regularly, vis-a-vis the banks that have their business model as just trading the interbank market. So one way of doing that is to disaggregate your sample by sizes of large banks, small banks, and these. So this one will have to allay our fears that risky banks are the ones that trade regularly in the interbank market.
Hello.
Hello. Sorry.
Yeah. Go ahead. Yeah.
So just like as I've said, you disaggregate the sample size by size, and then try to see whether the riskiness has nothing to do with the size, so that you show the pure risk effect in trading the interbank market, so that we know that it's not coming to the interbank market because of liquidity stress, but rather because of its relationship as a core bank in the interbank market. Otherwise, thank you so much for this paper. Thanks.
Thank you, Peter. Very helpful and timely comments. So let me pick some further comments. Esmie, if you wish that you want to respond to any of those, you can stop me. But otherwise, I'd like to go ahead and getting as many comments as possible. We're recording the comments, and as I can see you also taking notes, those are very helpful. At the end of the day, we'll have quite a rich set of comments and suggestions. Suriate Tumwine, please go ahead.
Okay, thank you so much, Chair and the presenter. I am a professor at Makerere University Business School in Uganda. And once again, I thank the presenter. Mine is what he
welcome, a slight and good to meet you online.
Yes, I got that link. I said I must attend and listen in. I think Wamarwa and Thomas will have echoed on it, where you said that you are looking at the interbank market discipline on bank risk. And somewhere as you are presenting it, it is as if the small banks face high risk. And my issue is, how you wish you do two things in your using your data set, because this is secondary data, how you could use carry out the analysis of variance, so that when we talk of the size of the bank, there are small banks, there are medium banks, there are large banks. Like what Will said, large banks are too big to fall and they might face lesser risk. Whatever the case may be, how I wish you would categorize them based on the analysis of variance, or you can carry out a Turkey's post hoc analysis. The Turkey's post hoc analysis can help you have the size of the bank, of course, based on their capital first. And then you have this kind of medium, small, and then large. Once you have that kind of categorization, then it's when you can be able now to tell us who faces a high risk, or whether is the risk-taking behavior high, moderate, or low. So that by the end of the day, we can be able to see good policy recommendations coming up and even scholarly. But now when you group them together, we don't know who is more riskier. Somehow, somewhere without that kind of categorization, one might feel that perhaps this is your own thinking, since there is no basis. That's my take. So I would explore you to do that kind of analysis, analysis of variance, or the Turkey's post hoc analysis, to have those different categorizations that can actually enrich your results and discussion. Thank you so much.
Yeah, thank you so much, Sulaite, to draw our attention to the differences in bank size in Malawi, and yes, to try to capture them in the analysis, accounting for variations in bank size. Thank you, much appreciated. Another comment by a long-time friend and esteemed researcher in the area of banking, Dr. Simpasa at the African Development Bank. Anthony, please go ahead.
Thank you, Prof, and good afternoon, colleagues. Let me join others in commending Esmie for a very well thought out paper, very well motivated indeed, especially that it's looking at bank level data, which is very rare in our context in African countries. So the granularity of this investigation really adds value to the investigation. I just have two specific comments. The other ones were brought out very well by Thomas earlier in the discussion, vis-a-vis the asymmetries in the results between the two solvency, between the two risk measures. So I will not go into that. It treated it very well. My comment, and forgive me if this has been brought out already, I had to step out at some point, so I might have missed this. Whether the interbank activity takes into account both the borrowing and lending activity. So are you looking at the net position per individual bank, or you are just looking at the gross position from the borrowing side. So, because there are some banks that participate on both ends of the market. So it would be nice to know specifically how are you treating this interbank activity. The second one is whether and how you are treating the cost of funds within the interbank market itself. I know that you have looked at the monetary policy rate, but also it would be nice to know just how and to what extent the cost of interbank borrowing itself does affect banks' risk, whether from the credit side or from the sovereign side, depending on how you have measured this type of risk. So I just thought I should raise those additional points if they have not been raised already. Thanks, Prof.
Thank you very much, Anthony, for raising this point. And I think the recent, PhD thesis by Anosi Ikimaro at SOAS does try to distinguish that the borrowing side and the lending side and the interbank market. So I think it's an important point. Whether it's possible within your data or not is something different, but something to be acknowledged in terms of what could be done, and then do whatever the data allows you to do. Yeah, excellent. Thanks, Anthony. Dr. Tulo Lawar is my colleague at the School of Finance and Management, SOAS University of London, and one of the drivers of the Center for Global Finance. Tolu, please go ahead.
Yeah, thank you, Victor, and thank you, Esmie. I found your presentation quite interesting, especially given the challenges relating to the collection of data in Africa. The results are also very, very interesting. Some of the issues that I have already been addressed by the previous contributors, but one thing that I wanted to highlight is the possible role of market discipline on risk. And I think you can capture this by incorporating whether the banks are listed or not as one of the control variables in your regression, because I think this variable ought to be important. I also checked the number of banks in Malawi. There are about 12, including the central bank, the Reserve Bank. It would be interesting to know the nature of these banks, because 12 is a small size, and you have not given us the distribution of the sample across time period and the nature of these banks. One would like to know how this may affect the results that you have presented. Again, I want to congratulate you for a job well done, and I wish you the best in your PhD journey. Thank you.
Thank you very much indeed, Tolu, for those contributions, and also thinking about peering into the listing versus unlisted banks, the listed being able to have a market-driven data. Thank you. Now we have Josiah Kiplangat, who is also a prolific researcher based at the Kenya Bankers Association. So, Josiah.
Thank you, Chair, and I really want to join the rest in congratulating Esmie for the very excellent presentation. I think I'll want to pick from the point that Tolu made on the role of market discipline, and perhaps it would be insightful to also consider the extent to which banks are diversified, and more importantly, funding diversification, because when you have non-deposit financing, these can also provide an avenue for bank monitoring. The second point I want to add is the fact that there are potentially omitted variables in your study, and it would be important to also incorporate that And these would include the liquidity positions, both the coverage and the asset liquidity, which in the literature has been identified to be very critical in explaining the risk-taking behavior of banks. And lastly, perhaps the extent to which banks are diversified in terms of their income sources would also be a critical component to look into in trying to explain the risk-taking behavior of banks. Thank you, Chair.
Thank you very much, Josiah, for those additional comments on especially on a variable that may have been omitted from the investigation, which could be considered for enriching the empirical specification that is estimated in this paper. Okay. I see Anthony's hand up. I'm not sure whether it's a legacy hand or you would like to come in again with a comment, Anthony. Okay, so moved. Maybe, oh yes, we have a comment from Kosam Chanda, another prolific researcher based at Bank of Zambia. Kosam, please go ahead.
Thank you, Professor Murinde. Thank you, Esmie, for the good work and clear presentation. Just a quick one. For me, just my quick thought is maybe you could also consider bank competition. Bank competition also influences how the banks behave and take up risks. So on the side of the Malawian case, I think that could also be quite a contribution to enrich your paper. Thank you.
Thank you, Kosam. I should have added that Kosam has also been undertaking studies on a interbank market jointly with his colleagues at Bank of Zambia. So thank you for bringing that point about bank competition. Maybe now, Esmie, we possibly do it the old-fashioned way of Group C at the ERC. In other words, I don't think you'll be requested to give a blow-by-blow response to each of those comments. That might be longer than the presentation of the paper. But maybe you can pick on some of those where I need to give an explanation or even ask questions if you want to. So maybe let me give you an opportunity to respond some of these points in the feedback where possible. Yeah.
Okay, thank you so much, Chair, and thank you so much, everyone, for your generosity. You have indeed given me quite a number of comments and ideas, and I thank you all. I should apologize because I wasn't able to share this paper, and think some of the confusion are coming in because people didn't read the actual paper, the whole paper, but some of the issues that have been raised are well explained in the paper. But that being the case, thank you so much. There are so many ideas that are coming up, and there are so many things to try. And I have quite a good data set that I can use and try all these issues that have been raised. And maybe even the idea that I've come up can even assist in coming up with another paper. But there are some other things that I need to clarify. For example, Anthony Simpas has raised the issue of whether I'm looking at borrowing or lending. In the current version of the paper, I was looking at the issue of borrowing, because my thinking was that the disciplining part is is more of the borrowing part than the lending part, whereby if a bank is perceived to be risky, it has difficulty to access liquidity in the interbank market. But giving me that comment, I think I'll also go back and consider the lending part, what is literature about lending and bank risk, and also I'll try in the estimation. But this is something that is very possible. I have the data, just have to put it in a form that can be used. And another thing is that of including other financial institutions in explaining bank risk. That is quite of a challenge, because I was looking at those institutions that participate on the interbank market. Not every financial institution participate on the interbank market. So that component of participation in the interbank market will be lacking if I have to bring in more financial institutions. But then maybe I can also I can still look at them and maybe see how the story will come up, but not necessarily maybe taking them on board when estimating the main regressions of this study. And on the issue of Dr. Thomas Wille, you questioned so much about the capital adequacy ratio and bank size. I didn't explain, sorry, because you didn't read the paper, but this is a ratio. So it doesn't matter whether it's a small bank or a big bank, because it's basically a ratio. So it's a ratio, it doesn't depend on the size. Yeah, but other than that, there was a question on maybe we should start looking into maybe making the interbank markets in the region more of collateralized. I think that's a good idea. And just to share with you, there's some initiative by Frontclear. I've done some work with them. I've published indicators of interbank markets with them. And part of what they're doing is to provide guarantees in interbank markets in Africa. And I think they'll be they're currently working with Uganda. They should be at a certain level with Uganda. And this is some of the initiatives which are very exciting and maybe of interest to be following. And you asked to say then what should central banks do given these results? And you and me are central bankers, so, Thomas and me, and I think we have more central bankers in the house. So this is something that we should think about. This is food for thought, and maybe we can continue it from this forum and see what we can do or in the interbank market. So I think I should stop here. Thank you so much, Chair.
Thank you very much, Esmie, for that response to the comments, and appreciating all the generosity of the participants as well as the discussant start with in those comments. I had a number of comments, but these were listed down, and I kept on ticking them one by one as the comments were being made. And almost all these comments are ticked off. So, you know, that's some of the comments you have already responded to, so I completely ticked them off the list, which is means that's a good presentation by you, a good feedback from the audience, and of course your response. I have only very maybe one or two very minor, perhaps comments. One is to put this paper in the context of the other papers on banking, the African continent, especially the new sense of Pan-African banks on the rise. Pan-African banks in full swing on the African continent. These Pan-African banks arising from say South African banks with a hub in South Africa, the hub in Kenya with the other Pan-African banks from Kenya, and the hub from Nigeria with African banks from Nigeria, and then of course Morocco, the Moroccan banks, which go as far down as South Africa. So I'm sure you know this on top of your head, but is whether some of these banks operating in Malawi fall in the category of Pan-African banks. because there is a paper by myself, Yusuf Somare, Lema Senbet, and Desri Kanga, in which we are looking at the behavior of these banks, and especially they tend to dominate the activities in the interbank market. The argument that Anos is making in his doctoral thesis about the core and the periphery. So I don't know whether it would be possible to kind of look at this in isolation. I can see the paper does actually the categorization very well. You have state-owned banks or government banks, and then you have private banks. You have domestic banks, you have foreign banks. This argument about Pan-African banks is to say that among the foreign banks, there are some Pan-African banks and then purely foreign banks which did not arise from Africa. The Pan-African banks are the indigenous African banks that started as a micro-saving organizations, microfinance organizations, but now have the muscle to compete globally. And are dominating the cross-border banking experiment on the African continent. So either way, if possible, you could shed light on Pan-African banks, and if there is no way, that would relegate the comment into a footnote. Still, a footnote would be desirable because that would mean people don't take you to task for ignoring Pan-African banks. Whichever way you can incorporate it in the study, that would be absolutely helpful. The second observation is about this I've been thinking about, and I'm not sure that I ever did it perfectly, so it's more or less maybe criticism on myself than anything else. I don't know your paper, but trying to explore the mechanism through which the interbank market affects bank risk. So you have your variable of the interbank market in the equation, the specification, the equation you have given, which is, I like that equation, and then the impact on a bank risk. But the mechanism maybe is not so clear to me, at least in the presentation, but it's maybe that in your full paper, there is already some work on the transmission mechanism. How does it happen, and how do we arrive at a positive impact of the interbank market on risk, or how do we get a positive impact, in which case it's increasing the riskiness of the bank, or negative, in which case it's risk reducing and therefore a market discipline, or increasing the market, in which case it's a contagion effect. And maybe one way of doing this, which you may wish to explore, is to explore whether we can use interaction terms to explore the mechanisms through which the interbank market affects bank risk. I'm thinking of two types of interaction terms. One, where the interbank market is interacted with the foreign banks, in which case we can see the interaction that basically, perhaps the sense that the interbank market works through the foreign bank, variable, in which makes maybe foreign banks, if it's a negative effect, very effective in imposing the discipline, or government banks for that nature, depending on what you interact. Or it could be the interbank market variable interacted with the capital adequacy ratio, where the capital adequacy ratio represents the baseline bank regulation as in Basel I, the initial capital adequacy ratio of 8% by that time by Basel I standards. So maybe that would give us an insight, in the empirical sense interpretation, on how the interbank market may affect bank risk. Maybe that interbank market works jointly with bank regulation to affect risk. Perhaps a final comment is on the measure of bank risk itself. I do appreciate, and I think you've done so well in capturing the historical risk, which is the loan loss reserve, and also capturing the measurement of the probability of insolvency, which is the Z score. And I wonder whether you have considered other options of bank risks, other measures of bank risk, other metrics of bank risk, and then discarded them, completely. And that's a prerogative as a researcher. You can consider the options and discard some, but you can just add the footnote to say you are aware of other measures for bank risk. Now, at the end of the ESRC project done by Panicos Demetriadis at Leicester, involving people, I think Robert Lessing was involved, and quite a number of people involved. They generated some data of measuring bank risk, and maybe there could be some measure there. I'm not saying you take them, but at least you have them. And if you don't like them, you can always include a footnote that you did survey them, you are aware that they do exist, but you decided against taking them. But also the Z score, which is widely used in the banking literature to measure the bank's probability of insolvency, has recently come under attack, and there are certain criticisms on this catch-all measure. Of course, it is simple. So apart from the apparent simplicity, there are some measures, some of its criticism say, well, the measure does not account for the degree of risk aversion implicit in the construction of portfolios of financial institutions. Some of them, I just say it does not provide an estimate, which can be a proper measure of variance. Whatever it is, what I'm saying is that it's okay to go with those two measures, but maybe let's not sanctify them as if they, give them high status. Maybe we should. You can be critical, of course. You can be critical of your own choices as a researcher. That's quite perfectly acceptable. That's what research is about. But also, be aware that the two measures of bank risk are not the only ones, and there are current criticism of them in the literature. But I did enjoy your presentation. Definitely, it will be a great paper and a great part of your doctoral thesis. Okay. Are there any? So I kept on ranting on for a while. Okay. Any other additional comments, observations? I can see quite a number of people here who've been working on this, and even some of the studies have been cited. Done jointly with people in the audience here. I can see Sophia and others. Any additional comments? I think everybody is saying we like the work, Esmie. Well done. Well done indeed. A great work. Thank you, and keep pushing. Let me switch on the hand of applause. Thank you very much. Thank the discussant, Dr. Thomas Wille. Thank all the people who have been able to make the comments, and also thank the supervisors. Yes, Chris would like to say something. Chris, please go ahead. I can see your hand up, Chris.
Sorry, that was my. I second all the comments made that this was really an excellent presentation. But actually, I put the hand up by mistake. So.
No problem at all. That itself, that comment itself is very. We do appreciate the work that you are doing together with the Kavita. And Esmie on taking this work forward. I could even give a start that Chris Green, Yebai, who is also in the audience, and myself, we started on this work of the interbank market in Africa with the World Bank project, and thanks to the generosity of Njuguna Ndungu when he was a governor of the Central Bank of Kenya, on allowing his free access to all the data, absolutely helpful. And that is where all this work started. So it's all going and gaining momentum and gaining great strength. Yes, I can see Yibai his hand. Yes, good. Yibai, like say something. You are you contributed to all this. very much.
Thank you very much, Victor, and thank you, Esmie, for this really interesting work and the presentation. I just have let's say a request rather than comments. We worked on the Kenya interbank market, and at that time it was difficult to find literature on African banks or even developing economies. And I think it would be really interesting for researchers like us to see, to have more information on research in similar type of countries, especially African countries. And you are in this position of central banker. I would suppose you have a lot of information on other banks, on other countries' institutional setting for your interbank as well. It would be really interesting for other researchers if you can make some comparison, to other African interbank market, especially in your context, whether that differences would affect their peer monitoring role or the contagion aspect. Yeah, thank you.
Thank you so much, Yibai. That's a very, very important observation and request. And indeed, as I said earlier, without the generosity and wise action undertaken by Njuguna Ndungu when he was governor to give us free access to data and to involve the collaboration with World Bank funding, yeah, I think all this interest in the interbank market possibly not have been able to do and the contribution. So I maybe Esmie, you'd like to say something in response to Yibai's a wise observation.
Yes, thank you so much. That is indeed a good observation. I think the way to go about it is collaboration. This because I know the other central bankers doing the same work, but it's because we are working as individuals, we are working in isolation. Maybe if we come together and maybe we find a platform of coming together and put our data together and maybe bring out something big, maybe that will make a very big difference on the market. Thank you.
Absolutely, Esmie. I second that. I agree with absolutely. Okay. Thank you to all of you, and once again, Esmie, Thomas Wire, all the participants, and yes, this has been a great meeting, and we wish you, Esmie, all the best in wrapping up your doctoral thesis, including this paper. Thank you all. Thank you indeed. Thank you. Bye-bye.